Hi, this is Lauren with Verivest, and today we are speaking with JP and Adrian from Thrive FP. Welcome, guys. We're really excited to speak with you.
Thank you.
Yeah, absolutely. So let's hop right in. I'd love to just hear how you ended up where you are today and give us just a little bit of your origin story.
Well, it started about 15 years ago, where it's kind of funny how things go full circle, but California was going through its own crisis back then, a housing crisis of couldn't afford it, just got married, moved to Austin, Texas.
Mhm.
I didn't know anybody when I moved out here. It was my wife and I that were like, let's just try this place, Austin. I think it's going to grow. And our hunch turned out to be great. And ironically, one of the first people that I got to meet when I moved to Austin, Texas was Adrian. And we were actually friends first for a couple of years. He was doing his own business, and really we were friends. And right in the middle of like as things were going bad during the last downturn, the recession, Adrian and I did lunch together, and really just two friends having lunch, thinking, how is this going to play out with the housing and the next kind of like pressure of what's happening with the economy? What do you think? And we both looked at each other and said, it's going to be a really rocky ride, but this could be a great opportunity. And that really was the time that we joined forces together as partners. We knew it was going to be difficult. And I think that, we really built Thrive one step at a time. I mean, we literally at the time, again, real estate was a little scary. There were some unscrupulous people out there, and we really knew that like fiduciary responsibility, and really building a different kind of company with transparency was going to be super, super important. So sometimes it's that adversity that brings two friends and great partners together in building a company.
Well, and I couldn't resist the salary at that time, which was zero.
Right.
Hey, great, I'll do it.
Yeah.
No, crisis creates opportunity.
Mhm.
And both of us really had a passion for trying to make the investment world different. Instead of taking advantage of investors, we really wanted to build a company based on investors for investors.
Right.
And that's really the genesis. I like to say, in trying to raise capital in 08 and 09 was character building.
Right.
We got a lot of hangups and a lot of, oh yeah, sure, send me some information, and nothing but crickets.
Yeah.
But we're both pretty stubborn and determined, and we really wanted to create something different in a time of crisis.
And the other thing, if you think about the name Thrive FP, this is definitely the spirit of Adrian and I. So Thrive FP is for purpose, for profit. So we are absolutely a for-profit. Our returns and our track record show that. But the kind of company we wanted to build also, we wanted to make sure that all the stakeholders, investors, our staff, the residents in our apartments, that every stakeholder would thrive. So the very name itself, and I think that if you look at our origin stories of where we came from, we wanted to build a different kind of company, not just be another real estate company, but really make sure that we were infusing mission and purpose and values into a great financial return. And I think what we've learned is that doing good creates doing well. So we've had better than market returns by simply doing the right things. And it's really a passion for Adrian and I, as the company has grown from this two friends having lunch to now over $1 billion of real estate transactions, and millions and millions currently that we have. We've done about 12,600 apartment units and about 400 million in loans. So two friends have turned this into something pretty special.
We started at 25,000 at a time. So that is all we got from investors, the confidence, which at that time we thought was fantastic.
Yeah.
Now the numbers are a little bit bigger, but the basis and the real drive is still the same. Before, it was trendy to say, oh, we do workforce housing. That's what we did. In 2011, it's all we knew.
Right. Oh, I love that. It's one of my favorite origin stories that I've heard so far. Really, it's really great. Yeah. Tell me a little bit of how you guys source deal flow and what your acquisition strategy is.
Sure. So in terms of sourcing deal flow, early on, we really decided that a lot of companies just build a large internal platform. And while that's great, and we do have an internal platform as well, we felt like, how do you really cover all these different territories? For us, we really focus on the smile states, which is the South and Southwest, from like Florida to Salt Lake. But how do you cover so much territory and be great at it, like a boutique thing? And we think that for us at least, we thought it was a mistake just to try to be great at everything in every market and be an expert. So what we've done is we've partnered with best of class operators and developers. So we've had about 20 partners, and the perfect partners, we don't want someone who's trying for the first time, and we don't want an institution. So we've been very blessed to really find these incredible people from Phoenix, from San Diego, from Texas. And really the part of our secret sauce has been really identify not just great properties, but great partners that really have the operational skill and, quite frankly, the same mission, that it is about returns. Ultimately, it's what we do for a living, but it's also like, how do we deliver the best community and resident experience at the same time? And I think that's been what makes us unique. About 25% of our owned real estate is in an internal platform, and then 75% of it has been an external platform. And that might change a bit because, quite frankly, we've got an amazing internal platform as well. But we love this idea of actually meeting and identifying experts in local markets.
And, as you can see, we're both introverts. So it's not difficult for us to go network at the big apartment functions to meet like-minded people, because operations can be operations. On a piece of paper, the numbers make sense, but you can move those and distort those for your benefit. It's really about people that are passionate about what they do. One thing JP taught me very early on, we can't do everything. And do what you're really good at. He and I don't want to do day-to-day operations on these complexes. So find the people that are truly passionate about that. And the nice thing is the marriage works well, because generally the operators are really good at operations, but they're not so great at raising capital. Well,
and managing the capital and reporting on the capital and everything that goes with it. Yeah.
So that really helps. And I think multifamily now is not what it used to be. The space is a lot more crowded. The good thing is the people that live in a lot of our properties need to live there. Well, why not make their experience a little bit better?
Yeah, absolutely.
Or a lot better.
Yeah. That's great. And you guys have touched a little bit on, markets that you operate in, but can you expand a little bit more of your key markets and how you select those markets?
What's funny is we could say we're very sophisticated and look at these research models and analysis. We bring a lot of common sense into what we do. It's not very difficult right now, in particular, to look at the states that are creating jobs and bringing large influxes of people. We've never seen in the US this much exodus from certain states, where the old way, you're too young, but we're a little bit older. It used to be, where do I plant my roots? And I stay no matter what happens. Yeah. If you look at Detroit, it's a perfect example, right? When the car industry left, a lot of people didn't leave because that's where their roots were. Today, it's a different dynamic. So we really target call it Georgia's, Carolina, New Mexico, Arizona, Texas, where we see clear job growth. And
South and Southwest region is clearly where the job growth is and where the influx is. So that's where
those are our renters. So the key to having these good JV partners is JP and I are believers in boots on the ground. You have to know your submarkets. Well, we can't know 50 submarkets, but if we can find 5 to 10 states and pick those submarkets that our operators know, JP and I are walking all our properties and we're walking the comps and we're getting a feel. but it's that day to day. So that's really what we target. And the beauty is some of our JV partners take us to new markets. Then we do our homework and see, is that a market where we want to participate in?
Yeah.
And just one example, like right now we have a joint venture partner that is really a specialist in Salt Lake. We love Salt Lake. That could be a whole other video, but we love Salt Lake, but it's a very hard market to get into, very hard to break into. And it really takes a local expertise. And so to have a partner that we've already done business with that already has 8 other properties out there, he has the contractors, he has the managers, we know, and by the way, we got the building off market, which is another advantage, is it's the network and the relationship. So we bought a property off market. That's the kind of stuff that I really think makes Thrive unique and special.
Right. Yeah. Really, basically creating an extension of the two of you in numerous markets around the U.S. and really making sure that those relationships thrive through.
We do. And then allowing that operator as Thrive to have some of those missions and principles that they're not used to an equity group. We call ourselves a relationship-based private equity group. That's really who we are at our core. And what does that mean? So we have our own ethos. And then again, we've learned that some of our partners, they love to do water savings and solar savings for residents, which by the way, also creates better ROI for the investors as well. And some of them like to express it in social impact. So there's different ways to express it. Right now, we're focusing with a nonprofit as well that we help co-create. And during this pandemic time, we've been working a lot on telemedicine with the largest telemedicine provider, Teladoc. So really, I think what we're really trying to do is just bring the mission in different ways based on the way that operator wants to express it or see it.
Yeah. Yeah. That's great. That's great. I love how you guys are really staying true to your original mission and seeing that through all these years. Yeah.
And it's growth. Yeah.
Just doing another deal.
Right.
It really means nothing.
Yeah.
It's being able to transform a property into a community where people love living and every business plan is different, because you could have young professionals at one property, you could have a Hispanic property or minority property. So the business plan changes, not what JP and I want. What do the tenants need? The launching of the Teladoc, JP really spearheaded that, was probably one of the best ideas we've done in a long time because of the pandemic, because of healthcare, because these people don't have access to it. Of course, when you present anything, the tenants hesitate to use it. Now we have over 5,700 tenants using it regularly.
Yeah.
And the thing to understand too, as an investor, and we won't, because we can go on, I know we got to keep moving on here, but the one thing to understand that I think is important for an investor is a strong community translates to resident retention. More residents stay for longer. They refer their friends, which means you have less downtime between units, which ultimately translates to better returns. So while we say all this, that's where the doing good and doing well connect, is that we keep finding again and again and again in our above market return performance, is that the secret salsa lies in that, and it does translate to investor return.
Yeah, absolutely. So tell me a little bit about your investment philosophy. You've spoke on it a little, but how do you determine whether a deal is worth doing or not?
Well, what we used to do, we actually, even though pricing has gotten way ahead of itself, we do a lot of the same things. And what's funny is JP and I, as soon as our acquisition team or some of our, we call them bird dogs, find some deals, we actually look at what can go wrong first to see if the price is already out of whack or what we would be willing to pay. One of the first things we look at is your debt coverage ratios. What's our safety, right? If things don't go as planned, if things don't go well, how much stress can we take before the deal doesn't pan out? With cap rates compressing so much, we are pretty adamant about not selling in 3 or 5 years at these cap rates.
Right.
It's irresponsible.
Mhm.
Could it happen? Yes. And if it does, we're all going to be happy. But we know from experience, when cap rates go against you, there's no way to make up that delta in value with, even if you have great operations, it's too big a deficit. So everything that we look at starts with 2 things: risk and reward. Are we getting paid enough for the risk that we take? And how quickly can a deal absorb things not going right? Once we feel comfortable with that, it might not be a sexy, huge return, but if we can mitigate the downside, we believe that apartments are going to stay stable for years to come, but we're not going to average 30% annualized returns, because that was a perfect storm, right?
Well, never say never, Adrian.
That's true.
You don't know, but the point is you hedge the downside. The one more thing I want to point out too is Adrian is highlighting our equity program about how we underwrite apartments, but on the investment philosophy, we also have $100 million. We've been doing this for many years, a debt fund where we act as like a private bank. And very similarly, it's a little bit different, but the same thing when we do loans, and we're very blessed with our performance on the lending side, but it's kind of a similar thing. Before you do a loan, you're looking at, loan to value, coverage ratios. I think what you're kind of hearing from Adrian thematically, whether it's our debt platform or equity platform, is instead of like over leveraging to chase a higher return or trying to get to a higher LTV just to chase a deal, I think we tend to we'll underwrite that downside a little bit more. And if we have to pass, we're okay with passing, but we really like the idea of making sure that how much wind can blow against this thing and we're still going to get through it. How will we get through it? I think that's a big theme that you're hearing from Thrive.
Yeah.
To give you an idea, last year alone, we made 30 offers on properties and we won 0.
By the way, we didn't make 30. We made about 150. 30 that we got to the best and final and didn't make it to the
those
final.
Right.
And we're, it's frustrating. Our acquisition team gets frustrated. JP and I are okay with it. We always say missed money is better than lost money.
Right.
So, it's always easier after the fact.
Yeah.
We should have done.
There's always another deal.
That's right.
That's always true. There's always another one right around the corner. Definitely. So tell me a little bit of how you generate value once you've made the investment. What's your risk mitigation strategy?
So we kind of talked a little bit about what the risk mitigation strategy is, but again, I think I would almost tell you that a lot of what we've been talking about with really focusing on really curating great communities is a risk mitigation strategy. What we've found with a lot of our apartments is that when you create these communities where there's this connection that the ownership is caring and engaged, your resident retention, that's a big number. Like what we've been finding on average, between 15 and 30% increased resident retention. Talk about your ultimate insurance plan. Having your buildings, having these people stay longer, knowing your neighbors, knowing your community, feeling like you're cared for. I always say if somebody sticks a plant in their backyard and starts a garden or paints a wall in their house, that's the difference of someone who's going to stay or is just going to leave. And some people just leave because it's, they're 23 years old. Like you're going to always get people moving, but that's, I really think that's part of what we do incredibly well. I mean, all the other things, best practices that Adrian's talking about. So don't over leverage your money, borrow a little less from the bank, raise a little more in equity. All these like stress test things are, have a little higher cash reserves just in case there's a pandemic. Why not have a little more cash reserves? So like there's things, I think those are some of the best practices that we do for risk mitigation.
So to really reiterate some of the numbers that JP is saying, average tenants stay about 11 months in an apartment complex.
In Texas.
In some of our properties, we're seeing 36 months, right? So that expense reduction of not only having to find another tenant, but think of the expense reduction of not having to fix a unit to get it ready, which is on the low end, $3,500, right? $3,000. So if we can do more of that and you get more renewals, which are about 80%, all of a sudden you have a very stable, consistent cash flowing property, and it's a win-win.
Yeah.
Today, it's easier to lower expenses than always think we have to charge more rent and choke the tenant, right? At some point, they're paying what they can pay, and you can get $25 more in rent, but what if we can reduce expenses by $200 a door? That the NOI likes that just as much, and it means more cash flow.
Yeah.
So
yeah, that's great.
Which we're doing, by the way, right now, but that's a whole separate story.
So you guys obviously make quite a great team, and you've spoken about kind of the relationships that you have in other markets that kind of are extension of your brand. But tell me a little bit of your key players involved that allow you guys to execute your acquisition and asset management strategy.
Yeah, absolutely. First of all, I'm going to start on the debt side. I want to give a shout out. Justin Bronya, our debt platform is called Thrive Lending. And Justin Bronya was a 20-year banker who was president of a bank here. In fact, he was our banker, which is kind of funny. And somehow we convinced him to come to the private side. So you have a guy with 20 years of banking experience with a wonderful business instinct. And I think what makes Thrive Lending kind of unique, quite frankly, is Justin Bronya. Loan committee is the three of us. We all take different things, but to have a 20-year classically trained banker with a good gut who can kind of let logic and discipline, kind of that beautiful balance, has been just absolutely fantastic, and a huge success, which is how we got to the 400 million of underwriting with a, knock on wood, a great track record. On the equity side, we've got a wonderful internal team. Just at Thrive, I think, part of what I said to you earlier, part of Thrive is you also want your employees to thrive. And I think that we've created this culture and mission where, thank goodness, people stay with us a long time. So whether it's the acquisition side on the underwriting, Joe Romano on our underwriting side, just he's been with us for years. He just knows the mission. He knows the numbers. He worries more than the rest of us, which is
and
what
he's young, which is crazy.
He's young and he's always worried, which is great. And then we've got, to fill in with the wisdom, we've got Jeff Greenberg and Chad Dobbs on the internal platform side. They've been with us really almost since the beginning, from that early lunch that Adrian told you about. Jeff's got 35 years experience together, like 50 years experience between the team. We've seen everything. And I always say to people who think that real estate's easy, it's only easy until you get hit on the head with a 2x4 and learn your lesson. And so I love this idea of a youthful mission with a ton of experience that has seen so many challenges, and we just know how to navigate this. And I think, look, at the end of the day, as you're an investor, this is never risk-free. It's always as Adrian says, you're balancing your risk and reward, and you got to do it. But what you can do, and this is the biggest variable you can do, is picking the right team, so that if there's an unexpected thing like a pandemic, a financial change, what team is driving and watching over your money? And I would say, whether it's Thrive or anyone else, that's the most important question that you really have to ask yourself at the end of the day.
Yeah. Yeah.
I always say our two toughest investors are our moms. No doubt. If you knew our moms, it would make a lot of sense. The JP and I have been blessed to be together and in this particular cycle at the right time. I still don't know exactly how we accomplished what we did. We're two of the larger investors in all our deals personally. So it's not close a deal, raise money, hope it works. It's actually until we sell or until a loan pays off, that's when we know it's successful. And we're all in it together. So our investors truly are friends and family. And I think JP said it correctly. When your staff culture and your business culture is the same, everybody thinks about these things for the right reasons.
Yeah. Absolutely. Adrian and JP, thank you so much for chatting with us today and telling us.
Oh, I thought, no, we don't have 15 more minutes?
You don't have 15 minutes? Sorry. I'm sorry, but it was great speaking with you guys and hearing more about Thrive. I really love your mission and how you guys run your company. It's really great to hear. So thank you so much, and we look forward to working together.
And Verivest
thank you so much. Yeah.
Yeah.
Thank you.
Guys.
Thank you.